All right, welcome into our third and final video on SPACs. In this video, we're going to talk about DraftKings and how they went public via a SPAC. All right, so again, this is our third and final video on SPACs, and this one is on the DraftKings going public. So again, a SPAC is just a special purpose acquisition company. In this case, they used a company called Diamond Eagle Acquisition Company, known as DEAC in this case, as we talk about it. In the public offering, they had 40.2 million units. And again, as in with the previous videos, the units consist of one share of common stock in this DEAC company and 1/3 warrant to purchase more common stock. And again, that would be after the transaction is effected. These special purpose acquisition companies are set up with the purpose of seeking out a target to acquire. Again, the deposits from this public offering were deposited into a trust company, and this again is common. In this case, they used the Continental Stock and Transfer Company. Again, that resulted in about $400 million in the trust account. That was the public offering. All right, so in addition to the public money, they did another PIPE transaction, and again, that's same in the Nikola. They also had a PIPE transaction, and again, that's just a private investment in a public entity. And in this case, that PIPE investment raised $380 million, and again, that's just going to be institutional investors and things like that. So that was done prior to the transaction, giving that DEAC roughly $780 million available to work with. Now, the transaction itself, again, this is very similar to the Nikola transaction. You had this public entity, this DEAC. It set up a merger subsidiary, which is just a wholly owned subsidiary, and that had that $400 million of public money as well as that $380 million of PIPE money. When the transaction occurred, this merger subsidiary invests cash into this private company. Again, in this case, that cash netted these investors in this subsidiary, this cash basically, it netted them 25% of this new combined entity. So when this reverse merger occurs, this private company, this DKSBT and SBT, which again is just DraftKings, and then this, which again is just this SB Tech, which is associated with DraftKings, and on this transaction, DEAC purchases DraftKings, makes this investment, and then also agrees to purchase all the stock of SBT, and the SBT was associated with DraftKings. So when this cash investment is made, the reverse merger occurs. So again, and you can see it in the previous videos as well. If you're confused about the idea of the reverse merger, basically it's akin to say a company like Facebook goes public. The entire company might be worth $20 billion, and when they go public, they just sell $1 billion to the public. When they sell that $1 billion to the public, they take in the $1 billion cash, and then they become a public company. Now it's done through a different organizational structure. And that's why these SPACs are popular, is they're generally considered quicker and easier, have less regulatory scrutiny, but it has that same effect. So when this cash investment's made in this private subsidiary, this new company is formed, DraftKings Inc., and that's what this merger sub becomes. It becomes DraftKings Inc., and that merger sub is effectively blown up, and DEAC itself becomes known as DraftKings Inc. as well. And this new DraftKings Inc. company, traded on the NASDAQ, 75% owned by these DK and SBT shareholders, 13% owned by the investors in this DEAC, the public investors, so this public money, and then 12% owned by the PIPE investors. So that's how it happened. Again, that's just another example. So the previous videos, which I'll put in the comments below, are Nikola, and then a generalized look at what happens in a SPAC transaction. So again, that was quick. Hope you enjoyed. Thank you very much.